Hi, this is Saitasky. I'll be talking in this video about bank reconciliation. You have to do bank reconciliation at least once a month so you can make sure that the balance per the book equal to the balance per the bank. So we'll see how we can do that and what is the most common problems we will see. First we will have this slide, we'll explain some steps we have to do, then we have an example, and we will do the answers of this example later on. So let's start. First we have to get the balance of the balance per book and the balance per bank, and compare these two balances, and you'll do some adjusting to it because most likely these two balances won't be equaled. So we'll see how we can adjust that and come to an equal balance. So first we have to adjust the balance per bank statement, and what we'll do is that we will deduct any outstanding checks. For example, when we give a check to one of our customers, this customer may not go and withdraw this check right away. The customer may wait for 1 month, 2 weeks, depending on the situation of that customer. So when we issue this check, we'll deduct this check from our balance in our general ledger. So we have to adjust this check and assume that this customer withdraw his check or her check. So we'll deduct any outstanding checks. We will add any deposits in transit. What that means? When you go to any bank and make a deposit, this deposit may not show up on your bank statement right away. It may take, for example, 1 week to show up. So we will add this deposit to the balance per the bank statement, and we will add or deduct any bank errors, because they may be some bank errors. So we have to add or deduct these errors depending on the situation. We'll see in the example how that may happen. Now we are done with the bank statement. Now we have to go and adjust the general ledger. In the general ledger we have to do more steps. We have to deduct any bank service charge. Bank service charge is applied to our bank account at the end of the month, most likely. So when we receive the bank statement, we will see like $10 bank charge depending on the plan, and we will deduct this bank service charge from the general ledger. Then we will add any interest earned during the month. So if we earned any interest, we will add it to our balance per general ledger. Then we will add or deduct any recording errors. Then we will deduct non-sufficient fund checks returned. So if we gave our customers any check and this check has returned because of non-sufficient fund, we have to deduct this check from our general ledger. Any pre-authorized amounts removed from the bank account, we have to deduct it in our general ledger. Let's see for our example here, and we'll see what is the most important things. So let's start. it's saying that bank statement of August 2015 shows an ending balance of 3,490. So we'll go to our answer sheet. And we will start by saying, as I said, we have two adjustments. The balance per bank statement we will write whatever is the balance of the bank statement here. Then we will deduct the amounts we received. Then we will adjust the balance per general ledger. So we will start with whatever the balance in our general ledger when we are doing the bank reconciliation, and we will do some adjustment to it. So let's start. First, it's saying that the bank statement of August 2015 shows an ending balance of 3,490. So the ending balance is 3,490. $34.90. On August 31st, the bank statement shows charges of $35 for the service charge for maintaining the checking account. So we have $35 of service charge. Where would we adjust this? Per the bank statement or per general ledger? Of course, per general ledger, as we said. So here we will deduct the banking fees Okay, let's continue. On August 28th, the bank statement shows a return item of $100 plus a related bank fee of $10. The return item is a customer's check that was returned because of insufficient funds. The check was also marked "Don't redeposit." So we have $100 check, non-sufficient fund check, plus $10 bank fees. We have to also adjust this here. $100 non-sufficient fund, and we have also $10 bank fees related to this. Number 4, the bank statement shows a charge of $80 for check printing on August 20th. So check printing, they give us some checks of $80 for printing these checks. $80 bank fees for checks. Okay. The bank statement show that $8 was added to the checking account on August 31st for interest earned by the company during the month of August. So here is some interest we have earned, so plus $8 interest Okay, after that the bank statement shows that a note receivable of $1,000 was collected by the bank on August 29th and was deposited into the company's account. On the same day, the bank withdrew $40 from the company account as a fee for collecting the note receivable. So we have received $1,000 on note receivable, and the fees for that is $40. So I'll go and add this. Note, and we have also $40 bank fees related to this transaction. The company's cash account at the end of August shows a balance of $967. So this is the balance per general ledger. So 967, what we started with. During the month of August, the company wrote checks totaling more than $50,000. So we have wrote checks with total of $50,000 during the month. As of August 31st, by the end of the month, $3,021 of the checks written in August had not been cleared the bank. So $3,021 of these checks of the 30,000 of the 50,000, sorry, has not been yet cleared the bank. And $200 of checks written in June had not yet cleared the bank too. So a total of 3,221 has not cleared the bank yet. So we'll go and add this to here, to outstanding checks. 3,221 outstanding checks. Okay, let's continue. The $1,450 of cash received by the company on August 31st was recorded on the company's book as of August 31st. However, the $1,450 of cash received was deposited at the bank on the morning of September 1st. So we have went to the bank and we have deposited a cash amount of $1,450, but this cash amount didn't show up until the September 1st, but we got the bank statement on August 31st, so this we can assume that it is deposits in transit. On August 29th, the company's cash account shows cash sales of $145. The bank statement shows the amount deposited was actually $154. The company reviewed the transactions and found that $154 was the correct amount. So here is an error, but it is not a bank error, it's a recording error. We made an error when we record these cash sales and we assume that it's $145, but actually it's $154. So there's $9 recording error. So we have to increase the number we have recorded by 9. So we have to go and say that here I have 9 of recording error. And now we are done with our case here, so we'll go and sum all of these adjustings, and it should be balanced. So balance per bank statement after adjusting equal to 3490 minus plus 1450, so it's 1719. So this is the adjusted balance, and now we have to check the same balance here and you write it adjusted here. So we start with 967, deducting 35, deducting 100, deducting 10, deducting 80, plus $8 plus 1000 minus 40 plus 9, it will be 1719. So as we can see, it is equaled. So we started with unequaled balance and we ended up with equal balance. Why this is important? So we can know if there is any updates. We have to do this every month at least once, because if you are doing it every year, there will be a huge difference and a lot of transactions went in the year, so it will be hard to do it. But if you are doing this in monthly basis, it will be easier. Of course, this depends on the size of the company. Some companies need to do it every week, so it depends on the company. Thank you for watching, and we'll see you in the next video.